Good day, everybody. Welcome to our quarterly webinar update. I'm Adrian Cronje, CEO of Balentine, and joining me today is also Gabe Lembeck, our Director of Research. You know, for many of us, the last quarter felt like it lasted a lifetime. Every day seemed like a week, and every week seemed like a month. Capital markets moved with unprecedented speed and fury. Indeed, over the course of just 5 months, the markets experienced what would normally unfold during a full market cycle, which typically takes closer to 7 years to run its course. So today, I'm going to walk you through our thinking as it relates to the great disconnect that appears to have opened up between the sanguine outlook capital markets are expecting and the tough economic reality we are likely to continue to face over the coming months. And Gabe will be sure to share with us a quarterly market recap along the way as well. Summer started with the world slowly emerging from the great lockdown imposed by governments worldwide to contain the spread of COVID-19. Indeed, remarkable progress has been made in understanding how to treat those afflicted, and in finding effective therapies to help recovery, and in developing a vaccination. But the world has come to the realization that this public health emergency is here to stay for a while, and that life and business will continue under a new normal. During our last quarterly update, we discussed how stock markets had entered a bear market, falling by more than 30%, and how corporate bond market spreads had exploded during the last few weeks in March in anticipation of a severe recession ensuing from the great lockdown. Finally, as expected, in early June, the National Bureau of Economic Research officially confirmed a recession began as early as February of this year. In late July, the first reading of the second quarter GDP report showed that the economy had contracted by more than 30%, its sharpest contraction on a quarterly basis since the Second World War. Yet, as the third quarter began, stock markets had recouped nearly all of their losses of the year and were within sight of the previous high water marks, while credit spreads had narrowed significantly, as economic data showed a better than expected recovery from very depressed levels. Notably, for the second consecutive month, the monthly jobs report came in ahead of expectations for June, while the Manufacturing Purchasing Managers Index, often viewed as a leading indicator for the economy, returned to expansion territory. 2020 so far has offered yet another reminder that capital markets lead the economy, not the other way around. And that is a key underpinning of our investment process, which captures the forward-looking messages that markets send as inputs into our models. Indeed, this has been the third highest 3-month performance for the stock market since 1954. The only two better outcomes were off the generational market bottoms of 1982 and 2009. Yet, the lasting damage inflicted on the economy as a result of the great lockdown cannot be underestimated. The unemployment rate remains at 11%, and there is evidence that permanent job losses from the pain inflicted on many small businesses is rising. As the alarming rate of new infections of COVID-19 continues to climb, the economic recovery cannot continue to accelerate and will likely plateau at much lower levels than last year without a decisive medical breakthrough or until the virus has run its course. Yet capital markets still appear to be willing to look beyond what is likely to be a difficult second half of the year, featuring a stop-start recovery. What many are referring to as a great disconnect appears to have emerged between the tough economic reality we are facing and the more sanguine outlook capital markets have priced in. Perhaps nothing paints a more ominous picture than the current valuation of the S&P 500 stock market index, whose trailing 12-month price-to-earnings ratio sits at over 25 versus a long-term average of 16 times. So what gives? Bulls argue such valuation measures always spike near economic lows and that the stock market actually looked even more expensive at the beginning of the bull markets, which started in 2003 and 2009. They will point out that more than 90% of stock prices come from profits earned beyond a year into the future. In other words, that stock market investors should worry less about the immediate future and much more about future earnings a year hence. They will also cite the extraordinary do whatever it takes approach from monetary and fiscal authorities, which is intended to provide relief to the economy and to plug the income gap. The federal government seems ready to do more if needed, even though further fiscal stimulus will not be as easy to hash out in a bipartisan way in the lead up to the November election. In the meantime, bulls also argue that the banking system entered the crisis well capitalized as a result of regulations enacted after the global financial crisis. And businesses are accelerating the adoption of the digitization of payments and other game-changing technologies such as web-based communication, automation, and artificial intelligence technologies to cope with the pandemic, which will allow for productivity gains and profits in the future. Lastly, bulls point to sentiment levels, and those are often a contrarian indicator, which are negative at the moment, with cash levels in money market mutual funds at very high levels and flows into bond funds sharply exceeding flows into stock funds. Indeed, the speed with which the Federal Reserve and Treasury acted is staggering. The Federal Reserve indicated it is unlikely to raise short-term rates until at least the end of 2022, while expanding its balance sheet to over $7 trillion, up from $4 trillion at the start of the year, in an effort to backstop the corporate and municipal bond markets. The US government is already one of the top 5 largest holders in more than 10 bond exchange-traded funds. That's a remarkable fact, and some are estimating it is on course to owning half of the tradable Barclays aggregate fixed income universe by the end of the year. After Congress passed the Coronavirus Aid, Relief, and Economic Security Act, or what has become known as the CARES legislation, the federal budget deficit, forecasted to be a mere $800 billion in January, is now estimated to be $3.8 trillion for the current fiscal year, driving up the US debt to GDP ratio by an extra 15%. On the other hand, bears will argue CEOs withdrew guidance to such an extent due to the highly uncertain outlook 3 months ago that the second quarter earnings season may bring worse than anticipated downward revisions to expected profits, dividends, and share buybacks. They argue that though the Fed's impact on the bond market is significant, there is still a chance today's deflationary forces and flight to safe assets could lead to negative interest rates, which has undermined the European and Japanese financial systems and economies over the past few years. In the long run, all the stimulus and debt piled up during 2020 may also lead to inflation and a debasement of the US dollar status as the world's only reserve currency, especially if a slower than expected economic recovery leads to a debt to GDP trajectory, which looks to become unsustainable more quickly. This is especially worrying in light of successive cohorts of baby boomer generations beginning to retire in earnest, stressing the entitlement programs of Social Security, Medicare, and Medicaid to a greater extent over the next 3 years. Finally, bears will point to policy uncertainty emanating from the upcoming election cycle in November. Concerns over its handling of the health pandemic and social unrest has led to the current administration falling out of favor precipitously, according to many polls, particularly in swing states and among key constituencies required to win re-election. 100 years of data suggest recessions and high unemployment preceding a re-election are notorious for ending presidencies. There is, of course, a long way to go until November, but capital markets will soon be handicapping whether an election sweep will lead to a Democratic president and Senate, under which a partial repeal of the 2017 corporate tax cuts to fund perhaps an infrastructure bill may be on the legislative agenda. In the short term, this would weigh on corporate earnings expectations. And in the interim, as the highly contentious domestic political cycle unfolds, the United States is, of course, experiencing difficult geopolitical relationships with both China and Russia. And now, I turn it over to Gabe to share the investment strategy team's quarterly market recap.
Thank you, Adrian. In contrast with the challenging first quarter, Q2 exhibited broad-based strength with all public asset classes finishing positive. However, even with the strong breadth, there was lots of dispersion. Looking building block by building block, for our liquid building block, aggressive interest rate cuts by the Federal Reserve in March led to a sharp decline in yields for cash-like instruments during the quarter. For our fixed income building block, all categories are now positive for the year, as shown on the previous slide, with municipal bonds having a strong bounce back in the second quarter. Yields on U.S. Treasuries, investment-grade credit, and high-yield credit all compressed during the quarter, much of which resulted from the unprecedented expansion of the Federal Reserve's balance sheet from early March through June 30th. This had the effect of not only lowering risk-free bond yields, but also compressing credit spreads as the Federal Reserve took on federal government paper, corporate paper, and municipal paper. The divergence in corporate and municipal bonds lessened during the quarter, following the first quarter concerns over municipal revenue, while Treasury inflation-protected securities, also known as TIPS, rose 4.2%. For our market risk building block, equities rebounded sharply as the worst-case scenarios that were priced in at the bottom did not come to pass. The S&P was up 20% during the second quarter, its best quarter since the fourth quarter of 1998. The difference between large cap growth and large cap value during the quarter was historic. Growth stocks were up 27.8%, sharply exceeding the 14.3% of value stocks, resulting from the disproportionate impact to fundamentals in the sectors, notably with the financial and energy sectors, which are mostly in the value group, bearing the brunt of the coronavirus pain. International markets also had a good quarter. Our models are warming up to emerging markets, with the weaker dollar a big help there. International developed was solid, but remains well off our radar in comparison with the US. Additionally, gold had a strong quarter, up 12.8%. Our holding period return through June 30th was 6.3%. Note that year-to-date through June 30th, the only positive asset classes were fixed income, gold, and U.S. large cap growth, all of which are part of the Balentine portfolio. In the alternatives bucket, broad hedge fund strategies lagged broader markets, returning a 2.3 decline for the quarter, bringing the year-to-date return to negative 2.0. So, what worked best for the quarter? Well, in our liquid building block, confidence in cash reserves enabled clients to stay the course during record volatility. For our market risk building block, the themes in equities that we emphasized, growth over value, US over international, and gold, have continued to outperform their benchmark in both up markets and down markets alike. And lastly, in our fixed income building block, we remain invested in broadly diversified funds and leaned on our active municipal bond specials to ensure high quality credit. Our underweight to fixed income helped overall performance. So what didn't work? Well, in general, alternatives. While we continue to view the alternatives asset class as a compelling diversifier beyond bond stocks, our current managers were not as additive as we would have liked. We believe a post-pandemic world will demand greater active management than these broadly diversified funds can provide. With that, I will turn things back over to you, Adrian.
Thank you very much, Gabe. So there are clearly reasons to be anxious about the apparent great disconnect which has emerged between capital markets and the economy. We believe the next 6 months are likely to bring greater volatility amid the current bullish versus bearish outlook and how those views will be reconciled. We remain attuned to the messages that capital markets send about the future and will aim to stay grounded, as always, in our disciplined process, which pieces them together to inform the decisions we make when positioning investment strategy. This has always been the best way for us to remain unemotional during challenging times, even if it feels uncomfortable to do so. Proactive rebalancing and selectivity will clearly continue to be key as the winners and losers in a post-pandemic world emerge. These have been the hallmarks of our process for more than 2 decades and are key to why we think the investment performance we've generated over the past few years will be repeatable in the future. We are proud of the advice we have provided our clients as we shepherded them through a very difficult and traumatic first half of the year in pursuit of their long-term financial goals. We are not going to be resting on our laurels, however. The investment business will teach you nothing, if not humility. We recall the bouts of frustration and impatience with all risk-managed and globally diversified approaches during a long, grinding bull market in the lead-up to the dawn of this decade. Thank you very much for the trust and confidence you place in our team. Finally, the 2020s are shaping up to being one of the most pivotal decades in history. There are so many important strategic questions about what a post-pandemic world will look like beyond financial goals and investment strategy. So we have kicked off a series of webinars over the next 6 months called The Road to Recovery, in which we have put panels of subject matter experts and business leaders together to discuss what enduring changes the coronavirus health pandemic will cause. Our first installment covered private markets with leading private market investors. In part 2, we hosted a panel on the global supply chain as businesses around the world are moving from a just-in-time to a just-in-case philosophy. And coming up soon, we will be exploring the strategic economic impacts from both a big and small business perspective, featuring Frank Blake, the former CEO of Home Depot and the current chairman of the board for Delta Airlines and Grady Memorial Hospital here in Atlanta. Frank has clearly had a unique vantage point into how this pandemic has unfolded and a view to its long-term consequences. So I invite you all to visit our website, balentine.com, to catch up on the series and to register so that you can receive future notice for each new Road to Recovery panel we will host.